Good afternoon, guys. This is Kevin Burnson, CEO of Admiral Insurance Brokerage. I'm excited to be here today. Excited to share our inaugural podcast. Today's topic is regarding some drastic changes that are occurring within the life insurance world. And our guest today is Chad Reyes, an industry expert at Wealth and Legacy Group. Welcome, Chad.
Hey, Kevin. Thank you for having me today. I'm certainly looking forward to this conversation.
Awesome. We come here today because there's a lot of changes in the industry that are going to take place effective at the end of this year, but they actually began at the beginning of this year. So over the course of a 12-month period of time, all insurance carriers are going to go ahead and start implementing these changes. And I wanted to share a little bit more in depth. I want to have an in-depth conversation about what these changes are. What do you think all of our clients should know about what's happening in the insurance world right now, and why is the present moment an important time in this industry?
Yeah, so Kevin, I love how we got to this conversation because you and I were having a discussion around some of the changes that are happening, and I had said, this is like a radical change that's happening to the life insurance industry. I've been in the business for 20 years, as you know, almost 20 years, and I've never seen the changes that we're seeing currently. The last time they had a change was in the early 1980s that had this level of magnitude. So for me, I love people and I love helping people and I love really guiding them. So this to me is near and dear because I don't think a lot of people really understand the impact that it could have on them. So I'm excited to just have this discussion and for us to really dive deeper into what's happening around the insurance world right now.
So presently, life insurance contracts have a minimum guaranteed interest allocation, and that is changing. So basically, governmental laws have implemented different strategies on that in terms of how the interest rate is credited to the policies. And the changes are not necessarily in the best interest of the insureds. The good news is there's still time to go ahead and move forward with those types of contracts. How does it work? How does the guaranteed interest work on an insurance policy?
Yeah, so I'm definitely, I want to go into that, but if I can I start back maybe 15, 16 months ago? Many of your clients and many of our clients, and I mean the whole world was impacted by COVID, right? So COVID really changed the game. And it changed everything. I mean, the way we operate, the world that we're living in is very different than it was just 15, 16 months ago. Well, the life insurance industry was impacted the same way. And in May of 2020, there was a major insurance company that was really pushing to get some changes done with the laws that are around life insurance, specifically some of the tax laws that are around it. Well, that fell off the plate and they didn't think they were going to be able to get it through. And then towards the end of 2020, a law got passed that basically allowed insurance companies, because of the impact of COVID and stuff, to reduce their minimum crediting rates. So for you and I know you have some permanent policies. I have some permanent policies. I have some whole life contracts, and they have minimum guarantees on there. So there's two parts to that contract. One is a minimum guarantee, and then one is a dividend, which is a non-guaranteed, right? And the insurance companies for many years have had a 4% minimum guarantee with a dividend which is non-guaranteed, but typically has gotten paid by any of the major insurance companies over the last 160 years. So what's changing and what's really being impacted by this law is that the insurance companies are going to have the ability to reduce the rate from 4% to 2%. And that is a radically different number. It only sounds like 2%, but when you look at a 2% contract over the life of that contract, 20, 30, 40 years, it radically changes the performance of the contract. And one of the things that we've been talking about lately with a lot of the advisory firms we work with, the accounting firms, the law firms, is how does that impact their clients? And that kind of led us to today's discussion, because I know a lot of your clients that have policies that were purchased before this law. That's not going to impact them. Those contracts are legally binding contracts, so they're going to keep to those 4% minimum guarantees. But when that law was passed at the end of December of 2020 and it went effective as of January 1st of 21, basically what happened is the insurance companies had the ability to create new contracts. So insurance companies are no different than other businesses, right? They create a product and they want to bring the product to market, right? Well, the insurance company now had the ability to create a new contract. And the way the insurance company world is, when you create a new contract, you have to then go to the insurance department to get it approved. And then you bring it back and then you get it out to your distribution channels, your advisors, your agents, brokers, etc., right? Well, right now, insurance companies, all of them, the Mass Mutuals, the Guardians, the New York Lives, the Met Lives, the Sun Lives, all of the insurance companies that are out there are eventually going to transition towards this new law, because it really does benefit the insurance company in the sense that they don't have to credit as much on the guaranteed side. They can credit it on, they can give higher dividends, but contractually they don't have to give higher minimum guarantees. So every insurance company is in the process of doing that, where they're starting to now go to the insurance departments to get approvals to then issue these new policies with these lower minimum crediting rates.
Understood. So in terms of the life insurance policy contract, so our audience understands, the minimum guaranteed portion of the policy is basically the minimum that they would have to abide by. Mm-hmm. Most companies don't advertise that as being their means of their interest rate. Most people go by what their current dividend rate is. Mm-hmm. How do you think that will be impacted? So the current dividend rate, which is usually announced on an annual basis, it has no long-term guarantees. Do you believe this law change will impact that adversely, because that's usually what they use to promote their product?
Yeah, so to your point, the and we're specifically right now talking about like whole life contracts, which are like the oldest policies, meaning they've been around the longest. Every product that is in the life insurance space, eventually it started from a whole life contract. That was the base chassis, and then eventually made it into all the different types of products we see today in the market. But that the interesting part is that insurance companies with the dividend, they're not guaranteed, so they don't have to declare a dividend, even though many of them have declared it for 160 plus years. What I think your clients need to know about this, and our clients, and quite frankly anyone who's purchasing insurance, is that the insurance company has to guarantee a certain percentage interest rate on the cash value that's in that contract. Currently it's 4%. It probably is going down to 2% once the new contracts come out. The dividend portion is where the insurance company gets the ability and the flexibility. So for those who are not familiar with what the dividend is, the dividend really is just a return of premium, because the insurance company calculated what the cost would be, and they had better returns, they had less death benefits that they needed, they had maybe better investment returns on their money, and then they come back at the end of the year and said, we had a good year, so let's declare a dividend and basically give that back to the policy owner, right? That's what a dividend is. So the new tax law changes it. Doesn't change how that happens, that process, but it changes it, and it gives the insurance company the ability to choose if they want to pay a bigger dividend or not. Whereas on the contracts that I have currently that were prior to 2021, those contracts that have 4%, the insurance company can't say, well, we had a bad year, so we only want to give 2%. Now, the insurance company has the ability to give the 2% moving forward, and then they can choose if they want to give 2% more in the form of a dividend, but they don't have to. It's a big difference, and I always share this with clients. There's a big difference between wanting and having to. Big difference. And right now, the insurance company, with the new laws, once it's fully in effect, the insurance company doesn't have to. They could do it if they want to. Radically changes the game.
How do you think this will affect, what impact will these changes have on premiums and death benefits respectively? Do you personally believe that it would, some may think that, hey, this should lower my premium because they're going to guarantee me less, without knowing all the moving parts that are within a whole life contract. What's your opinion on how it's going to be impacted, and have any companies done this already that we've seen? Is there any indication of what's to come as it relates to premiums and death benefits with this change?
Yes, so there have been a few companies, I won't throw out all their names out there, but there have been a couple of companies that have done that. They've already implemented the new products, and what we're seeing is anywhere from 50 to 75% increases in premium. Meaning, if a policy is I'm making it very simple. If policy is a $10,000 premium policy, typically you're going to see anywhere from it being, $15,000 to $17,500. That's a pretty substantial difference. I mean, the good thing is that it shows up in your cash value, but if you're looking at it from a premium level, it's a higher premium. Okay, so the same amount of premium is going to typically buy lower death benefit. So these are the people that I'm saying really need to be aware of it. If people are looking to buy it for estate planning purposes, because meaning they need a certain amount of death benefit to create liquidity to pay the estate tax, people who have death benefits who are trying to fund buy-sell agreements, people that are using it for death benefit purposes, right? Those people, it's going to impact them because they're going to have to pay more amount of premium to get to that same amount of death benefit, right? Where I think in the future it can benefit people is if the people are using it purely as an accumulation vehicle and they're just trying to stuff as much into the life insurance contract as possible. Well, because the lower interest rate amounts, they'll be able to put more into the contract without it affecting them. It's called the modified endowment contract limits. Basically, for the listeners here, the IRS realized what people were doing many years ago, and people were basically taking life insurance contracts because all the phenomenal tax benefits, it grows tax deferred, it comes out tax free, it's a form of a policy loan. Well, they recognized what was happening, and what they did is they said, you're not using this as insurance, you're using this as an investment vehicle, so we're going to put limits of how much you can put into that contract.
Taking advantage.
Correct. So they put those limits on, and those are called the modified endowment contract limits. Well, for people who like doing that to their policies, meaning how do I get as much into the policy, in the future they'll be able to put more into the contract. But for people who, and I don't think that's most of the people, I think that's a small percentage of the people, but for majority of the people who buy it for life insurance, for the death benefit, and just the guaranteed cash value, this is going to impact them. For the people that are saying, I want to get more into the contract and I want to bring it up to the limits of the IRS limits, then this could be potentially a benefit for them. But that's such a small part of the population.
So in terms of candidates and action steps, I mean, the clock's running. You mentioned before that this change took place early in 2020, and basically it sounds like the insurance companies need to take their action steps by the end of the year. So
and it's in their benefit. I mean,
they're going to do it.
Yeah.
So it seems like, why wouldn't they do it?
Yep.
Who do you think the ideal candidates are? So if you're someone that was kicking around the idea of buying life insurance, it seems like if you're that type of person, you should have been like, this is a reason to move forward with the contract. Do you know like an ideal person that should be using this as an opportunity to take action in their lives? That take those next steps.
Yeah.
Over the next 6 months.
So I've been saying this. Kevin, that we work. Our practice is designed with law firms, accounting firms, wealth management teams, family offices, and I've been sharing with these advisors that the opportunity here is for the clients and the people who have been saying, I really want to buy that insurance. I don't know if it's for the person who's never thought about insurance. I mean, it could be. But I think right now, because of the short window of opportunity that's here, it's for the clients that are saying, I really should buy that insurance. And they've kind of been on the fence. A case in point, right? I own a lot of permanent life insurance myself. And my wife and I were talking about, Danielle, so we were talking about converting one of her life insurance policies, right? And I was going to convert it in next year, January, February of next year, the whole thing. And when I found out about all the law changes that were happening, we made a decision to do it this year. And it was very simple. This was my mindset. It was, why would I want to convert my policy to a policy that has a 2% minimum guarantee next year when I can do it this year and have a 4% minimum guarantee? So we converted it and we did it this year, right? And I think there's a lot of clients that right now are in that position where they're like, I do want to purchase insurance, predominantly permanent insurance. This doesn't apply to term insurance, so it won't affect the term insurance world, but it will affect the permanent life insurance world, the whole life, the universal life, things like that. So anyone who's been thinking, maybe I should get that life insurance, I've been on the fence and I've been thinking about it, or maybe I was thinking about doing it next year or 2 years from now. Now's an ideal time because you're going to have so much more benefits for you and your family and your business if you're a business owner. Those are the people that are on. Those are the people that I think that really this message matters most to. They're on the fence. They know they need it. Now's an opportune time. Why pay more next year and get less in the form of a death benefit and in the form of lower rates of return if you know you're going to need it anyways?
So it sounds like to me that it's an important time to take action, but it also sounds like the insurance business will continue on thereafter. It's kind of like if you lease a car, maybe that price you paid last year is no longer that price that you won't see that price again, but you still need the car to drive. So we're not, we're indicating that you would, if you were looking for the opportunity to buy insurance and you've been on the fence or you have some interest in it, now seems like an ideal time to take action, and it seems like a good time to jump ahead. Similar to the mortgage refinance market. A lot of people in the last few months, the year, everyone's talking about how they reduced their rate. Why did they take those actions? I would venture to say that 6 months ago, someone did not ever think they were going to refinance in the next 6 months, but there was a change in the industry that benefited them, that made them take that action, and suddenly the refinance market boom occurred. So life insurance will continue thereafter, but in the present moment, there's no doubt that now is a hot time to take action if you were.
Oh, certainly. Now is the time, and I want to share this. And I think it's important because life insurance sometimes has a stigma. We see people just selling policies, and unfortunately, a good portion of the industry really doesn't look at it through advising. They look at it through selling. But I think right now, and that's what I love about what you guys are doing, you really like to advise people on how to purchase their insurances, right? I think right now is where people need to look at it and say, I need an insurance advisor. Big difference. The industry is tremendously changing. People don't need a salesperson to sell them a policy. They need an advisor to be able to come in, look at what they're doing, and be able to give them really good, solid guidance and advice of how to move forward. Because these contracts are legally binding contracts. Most people think when they buy life insurance, I just bought a product. No, you bought a legally binding agreement. When you sign a mortgage agreement, it's a legally binding agreement. When you close on your home, legally binding agreement. And it's the same thing with a life insurance contract. So if it's a legally binding agreement, then you want to work with an insurance advisor. And I think what you're doing with your wealth planning division is phenomenal. How you're building up advisors to be able to help people really advise them on their insurance portfolios. So I would just encourage people to connect with you guys and really have an advisor review it. Not look at someone who just wants to sell you a policy, which is, listen, it may be the perfect opportune time to buy the policy, but make sure it's being advised and not sold.
It's the perfect opportunity to buy the policy, but it may not be the perfect opportunity for the person to buy it. That's up to the conversation between the advisor and the insured. Sounds like we got everything covered. It's actually a pretty simple concept now that we've broken it down. When I hear the term 7702, it's very scary sounding, but basically it's just an interest rate change, and that will have a great impact on the policy, especially when you take into consideration the compounding effect of a 50% less guaranteed interest rate. So we're looking forward to sharing this with our clients. We're looking forward to helping any one of them move forward. I thank you for being with us today, and looking forward to the next time we get together.
My pleasure, and thank you for having us. And just quickly though, if anyone is on this podcast listening and they had questions, who can they contact?
They can contact our client success specialist, which is Alexandra Zhila. They can call our office at 718-241-8500, and she's extension 104.
Great. Well, thank you, my friend. I enjoyed this conversation. Thank you for having me.
Thanks.
All right.
See you soon.
Be well.